Hi, and welcome to the January's edition of the Global Market Highlights. Over the next 10 minutes, I will walk you through the key developments shaping global markets as we head into the end of the month. From there, we will explore our latest investment house views across major asset classes, highlighting where we see opportunities before we wrap up with a look at the big structural forces we believe will define 2026. With that, let's begin our market performance review. Looking at market performance as of January 23rd, we saw a strong start to global equity markets, with Asian equities being the top performer, returning close to 6%. While major markets entered the year near record highs, January saw renewed volatility as investors reassess inflation trends, central banks' path, and evolving geopolitical risks. Rising concerns around global trade tensions and Middle East developments weigh on sentiments, contributing to volatility across risk assets. At the same time, confusion surrounding US Europe relations regarding Greenland added a layer of geopolitical uncertainty, pressuring risk appetite. On a positive note, US companies have started their quarter four earnings season. As of 23rd Jan, about 13% of companies in the S&P 500 index have reported their results. Amongst them, 75% of these companies reported a positive earnings per share surprise, while 69% reported revenue surprise. The market's estimate for Q4 earnings growth is at 8.2%, which will mark the 10th consecutive quarter of earnings growth for the index and show continued resilience amongst corporate America. In the bond market, we see healthy demand for global high yields that returned 0.74% month to date, given strong investors' demand driven by risk on the environment and ongoing fiscal expansions. Overall, we are seeing increased volatility in the bond market amid desynchronizing global central banks' policies. These diverging policy cycles are prompting investors to reassess duration exposure and positioning, amplifying volatility as capital shifts between markets in search for yield stability. One concern is about central banks' ability to contain medium-term inflation, with long-end yields across US, Europe, and Japan reaching multi-decade highs. At the same time, markets are being more sensitive to fiscal signals, where widening deficits and higher expected issuance are contributing to repricing, as investors expect higher term premium to compensate for added risks of inflation and fiscal uncertainty. On the macro data review, let's start with the growth picture. US gross domestic production came in at 4.4%, matching expectations and improving from the previous 3.8% reading. This reinforces the theme of continued economic resilience, supported heavily by robust consumer spendings during the holiday seasons. On the inflation picture, while US core personal consumption expenditure remains above the Fed's target of 2%, the reading was in line with expectations and moving in the right direction. More importantly, it gives comfort to markets that the effects of trade tariffs have so far not seeped into the inflation numbers. On the Service Purchasing Manager Index, a print above 50 signals expansion. Latest reading shows 54.4, beating estimates and higher than prior periods. This signals that business activities remain solid despite tariff and trade uncertainties. Upcoming data to keep watch includes US Consumer Price Index that will be released on February 11 and US Personal Consumption Expenditure on February 20. These will provide more clarity on the US inflation outlook ahead that will influence the Fed's path on monetary policies. At AIA Investments, we are anticipating another two rate cuts by end 2026 that will bring the Fed fund rates towards the 3% neutral range. On AIA's latest house view on the asset classes, we remain cautiously optimistic on global equities backed by strong US corporate earnings, healthy ongoing capex investments into AI innovation, and ongoing macroeconomic resilience. The ongoing normalization of global central banks' policy helps to establish a supportive backdrop for risk assets. On Asia ex-Japan equities, we remain overweight on the region that's experiencing higher earnings growth, particularly driven by AI-related demands, improving technicals, and steady earnings per share growth path. We see strong structural tailwinds such as broad AI adoption, economic security reforms, and a recovery in domestic consumption. And this will help create a broadening opportunity set for investors. Importantly, Asian equity performance is being supported by more balanced drivers: valuation re-rating, earnings impact, and shareholders' yield. Compared with developed markets, the region remains more attractively priced. On global fixed income, we hold an underweight view. The recent December Fed rate cut reaffirms the ongoing easing cycle, which limits the potential for yield upside from here. This environment makes fixed income less compelling relative to equities, especially with long-term yields edging lower. Within credits, we have just downgraded investment grades to underweight because of significant net investment grade issuance, largely driven by AI capex related kind of issuance that will likely lead to spread widening. We maintain an underweight on US high yields due to tight spreads, signaling stretched valuations at this point in the cycle that is priced for perfection. Lastly, on cash, we remain underweight cash. As market sentiments improve and risk appetite strengthen, holding excess cash becomes more costly from an opportunities return perspective. We prefer reallocating cash towards risk assets, particularly equities, where we see more compelling returns potential. Moving to the key megatrends for 2026 that underpins our investment outlook and our core considerations in our portfolio positioning. On the first megatrend, investing in the AI revolution. Over the last 2 to 3 years, AI has evolved from experimentation to real-world implementation at scale. In 2026, this could mark a new phase where we see a wave of capital and innovation flowing into traditional sectors like utilities and industrials. At the same time, we may see massive investment flows from corporates as they increase capex to integrate automation, data intelligence, and productivity tools and embed this technology into core operational processes. We are seeing massive industry transformation, where legacy sectors are undergoing structural changes as AI reshapes cost structure, supply chain, and business models. For investors, this means opportunities are broadening beyond the usual tech names into enablers, adopters, and beneficiaries across the value chain. On the second mega trend, geopolitical fragmentation, we are seeing major economies recalibrating alliances around national security, technology control, and resource access. From tariffs to industrial policies, governments are on diverging policy paths, prioritizing self sufficiency and resilience. Trade flows and supply chains are becoming more regionalized as economies step up on protectionist policies. For markets, while volatility remains persistent, it also presents new investment opportunities, particularly in strategic industries such as semiconductors, clean energy, defense technology, and supply chain infrastructure. On the third megatrend, diverging inflation path, we are seeing global central banks adopting different pathways as targeted tariffs and trade barriers shift cost structure unevenly across economies. This results in disruptive supply chain reconfiguration, altering price transmission. At the same time, different economies are experiencing different growth trajectories, with some economies running hotter while others normalize more quickly. We may see increased fixed income and currency volatility depending on central bank's response that requires more nuanced approach towards portfolio positioning. With that, I've come to the end of this month's update. I hope this gives you a good understanding and clarity of the market outlook and opportunities ahead for the year. Thank you once again for joining us, and please stay tuned for next episode in February. Thank you.